Hello teacher. My name is Jason, and today my group, which is Eric and Zeno and I, will presenting about master budgeting, chapter 8. Uh, the basic framework of budgeting. A budget is a detailed quantitative plan for acquiring and using financial and other resources over a specified forthcoming time period. The first is the act of preparing a budget is called budgeting. The second is the use of budgets to control an organization's activities is known as budgetary control. Now, I'm going to skip all this and get to the key points. So, learning objective 2. Prepare a sales budget including a schedule of expected cash collections. Budgeting example. Let's say that a company is preparing budgets for the quarter ending June 38th. Budgeted sales for the next 5 months are, you can see here, and you have to take notes because in this presentation, it will be used as for the long of the presentation. Now, the selling price is $10 per unit. This is the example of sales budget. The individual months of April, May, and June are summed to obtain the total budget sales in units and dollars for the quarter ended June 38th. For April, you can see that it is 20,000, find it here, and the selling price is $10. So you get the total budgeted sales of $200,000. The rest is the same. You times it with $10. And after you get all this, you sum it the total budgeted sales for April, May, and June, and you get the quarter total budgeted sales. Now let's move to expected cash collections. Let's say that all sales are on account. A royal collection pattern is 70% collected in the month of sale, 30% collected the month following sale. In April, the March 31st accounts, a receivable balance of 30,000 will be collected full in April. Now, this is the example of expected cash collections. You can see account receivable 30,000 from the account receivable from the March, and you get this 200,000 from the sales budget for April, because it said that 70% are collected of the month of sale. So only 70% of the $200,000 will be on April, and the rest will be on the May, which is 30%, equal to 60,000. The rest is the same. 70,000 of 500,000 will be on May, and the rest will be on June. Quick check 1. What will be the total cash collection for the quarter? The answer is D. Now let's find it. Now, because we already find the April sales and May sales cash collections, we just have to find the June sales, which is 300,000 times 70%, which is $210,000. And if you're wondering where the rest of the $300,000 is, that the rest will be in July. So after all of this, you just have to calculate, and you will get the total expected collections for the quarter, which is 940,000. You can find here. Learning objective 3, prepare a production budget. The production budget must be adequate to meet budgeted sales and to provide for the desired ending inventory. Let's say that the management at a company wants ending inventory to be equal to 20% of the following month's budgeted sales in units. On March 31st, 4,000 units were on hand. Let's prepare the production budget. Now, here is the example of the production budget. The budgeted sales in April was 20,000, 50,000, and 30,000, if you remember. And to get the required production, first you have to add the desired ending inventory. Now, if you're asking where do you get the 10,000? Well, if you remember, it said that the management wants ending inventory to be equal to 20% of the following budgeted sales in units. So because the following units of April is May, which is 50,000, you just have to times it with the 20%. So you will get 10,000 here. Now, after you calculate it, you will get the total needs. But because you have the previous beginning inventory from the previous month, you have to subtract it. So the required production is not over. So after you subtract it, you will get the total 26,000 for the required production for April. Now, quick check too. What is the required production for May? The answer is 46,000. Now, where do you get this? The way is the same with the previous April. So add the desired ending inventory, which is 30,000 times 20%, you get 6,000. And you calculate it. So now, if you're wondering where this came from, well, because the ending inventory from April is 10,000, this will become the beginning inventory in the next month. So the desired ending inventory from April move to the beginning inventory for May. You subtract it, and you get the required production 46,000. Now, because we already calculate for May, we just have to calculate for June and the quarter. And to get the June is to calculate the desired ending inventory. Now, this is a bit tricky because you have to remember the budgeted sales for July. So because the budgeted sales of units for July is 25,000 units, you just have to multiply it with 20%, and you will get 5,000. And you calculate all of this, you get 29,000. And for the quarter, you just have to sum all of budgeted sales from these three months, and you get the budget sales for the quarter. Now, to get the desired ending inventory for the quarter, you just have to move the desired ending inventory from June to the quarter, and you calculate it, and you have to less it with the beginning inventory, which you will get from the beginning inventory from April. And required production for the quarter is 101,000. Let's prepare direct materials budget, including schedule of expected cash disbursements for purchase of materials. Let's say that at our company, 5 pounds of materials are required per unit of product. Management wants materials on hand at the end of each month equal to 10% of the month's following production. On March 31st, 13,000 pounds of material are on hand. Material cost is $0.4 per pound. Let's prepare the direct materials budget. Now, this is the direct materials budget. Now, so you have you get these numbers from the previous production budget, which is 26,000 for May, 46,000 for May, and 29,000 for June. And to get the production needs, you just have to multiply it to the 5 pounds from these informations, which said that 5 pounds of material are required per unit of product. So this is the production needs. Now, to get the desired ending inventory for April, if you remember that it said at the end of each month equal to 10% of the following month's production. So because the following month's production is 230,000, you just have to multiply it to 10% and will get this number. And lastly, you just have to last beginning inventory for from the 31 March inventory, and you will get 140,000 for materials needed to be purchased in April. Quick check 3. How much materials should be purchased in May? The answer is 221,500 pounds. Now, how to get this? Now, to get this, we just have to add desired ending inventory from June, the 10% of June production needs. We'll get this number. And lastly, you just have to subtract it with the beginning inventory, which you get from the ending inventory from April, and you get the answer 221,500. Now, this is a bit hard for the June at ending inventory, because to get this number, you have to calculate the required production for July. So because I already calculated in paper, I get the required production for July is 15,000. So the 10% will be the 11,500. And you get the materials needed to be purchased is 142,000. So to get the quarter, it's easy. You just have to times it, the total production for the quarter, which is 5 pounds. And at the ending inventory from June, just copy it. And you just have to get the last beginning inventory from the April, 13,000. And you get the materials needed for purchase in the quarter is 503,500. Expected cash disbursement for materials. Let's say that Royal pays 0.4 per pounds dollars for its materials. 1/2 of a month purchases is paid for in the month of purchase. The other half is paid in the following month. The March 31st accounts payable balance is $12,000. Let's calculate the expected cash disbursement. This is the expected cash disbursement for materials part 2. Now, if you remember, the accounts payable from March is 12,000, which will be accounted here, 12,000, and so we just have to calculate the April one. And if you're wondering where you get the 56,000, you get it from the 140,000 from the previous materials needed to be purchased times $0.4, and you will get the 56,000. Quick check 4. What are the total cash disbursement for the quarter? The answer is $185,000. The rest is the same, but because June, because it's quarter, so the half percentage for the 56,800 will be posted in July. And after you get all of this, you just have to sum it up, and you will get the 185,000 for the quarter. Okay, lastly, learning objective 5. Prepare a direct labor budget. Let's say that at Royal, each unit of product requires 0.05 hours or 3 minutes of direct labor. The labor can be unskilled because the production process is relatively simple and formal training is not required. Royal pays its workers at the rate of $10 per hour. Let's prepare the direct labor budget. Now, this is the direct labor budget. Where do you get this units of production? Well, you get this from the production budget. And to get the labor hours required for the month, you times it with 0.05 or 3 minutes, and you get 103,000 hours for April, and the rest is the same. Lastly, to get the total direct labor cost, you just have to times the previous labor hours required to the hourly wage rate, which is $10. So this is the answer: 13,000, 23,000, and 14,500. So the total quarter labor cost is $50,500. So this will be the end of my part, and my friend Eric will explain about the prepare manufacturing overhead budget.
Jason, can you enable screen sharing so I can share my screen?
Oh, what? Oh, wait. Okay, then I make you the host.
Okay. So I will be talking about how to prepare a manufacturing overhead budget. So the following information follows. At Royal, manufacturing overhead is applied to units of product on the basis of the direct labor hours. So the variable manufacturing overhead rate is $20 per direct labor hour. The fixed manufacturing overhead is $50,000 per month, which includes $20,000 of non-cash costs, which primarily consists of the depreciation of the plant assets. So to prepare the manufacturing overhead budget, we first need to list down which months we're doing. For this, it's April, May, June, and following information that's necessary. So for firstly, the budgeted direct labor hours. So for April, it's 1,300, May 2,300, and 1,450 for June. So for the quarter, it's 5,050 hours total. Then we fill out the necessary information. So variable manufacturing overhead rate, it's $20 per hour, and manufacturing overhead costs. So we multiply that. We multiply the labor hours by the manufacturing overhead rate. So that gives us the manufacturing overhead cost, and we add that by the fixed manufacturing overhead cost to get the total manufacturing overhead cost. So if you want to find out the manufacturing cost, we divide the total quarter manufacturing overhead cost by the total labor hours to get the average $49.7 per hour. So on why we have to decrease minus non-cash costs, as the following problem said, depreciation is the main non-cash cost. So we minus subtract the total manufacturing overhead cost by the non-cash cost, which gives us the cash disbursement for manufacturing overhead costs, as you can see below. So this is the ending finished budget cost. So it's the production cost per unit, the direct materials. You list down the quantity, the amount, and the cost. So you get the total over here after multiplying both of them. For direct labor, you get the hours and the cost. So over here, it's 0.05 hours and the cost is $10. So the total is 50 cents. Then you get the manufacturing overhead, which is in the previous problem, it's $49.70. And the quantity is 0.05 hours. So the total is $2.49. And you get the total which is $5 here. And for the budgeted finished goods inventory, if you first need to know the ending inventory in units and the unit product costs, which will give you the ending finished goods inventory. So in here, the ending inventory in units is 5,000 units. So you multiply that by $5, which gives you $24,950. So for the next learning objective, it's on how to prepare a selling and administrative expense budget. So at Royal, the selling and administrative budget is divided into variable and fixed components. For the variable expenses, which is 50 cents per unit sold, and for the fixed, it's $70,000 per month. The fixed selling and administrative costs include $10,000 in costs, primarily depreciation that are not cash outflows of the current month. So to prepare the company's selling and administrative expense budget, we need to get the budgeted sales, and we multiply that by the variable selling and administrative expense, which is 50 cents over here. So for April, the budgeted sale is 20,000, multiply that by 0.5, which gives you the variable expense, which is $10,000. And you add that to the fixed selling and administrative expense, which is $70,000 a month, which gives you a total of 80,000. And you subtract the 10,000, which primarily consists of depreciation, which will give you the cash selling and administrative expenses of $70,000. And you calculate that for the rest of the months. So this is the quick check. What are the total cash disbursements for selling and administrative and expenses for the quarter? So in order to figure that out, we need to calculate for the rest of the months, May, June, and add the total, which will give you the cash disbursements. So over here, that's the answer. You calculate everything: 70,000 for April, 85,000 for May, and 75,000 for June. And you add everything together to get a total of 230,000. So for the next part, we will learn how to prepare a cash budget. So a cash budget is divided into 4 main sections. The first one being cash receipts section, which lists all cash inflows excluding cash received from financing. The second one being cash disbursements, which consists of all cash payments excluding repayments of principal and interest. And the third is cash access or deficiency section, determines if the company will need to borrow money or if it will be able to repay funds previously borrowed. And the last one, the fourth one, is the financing section, which details the borrowing and repayments projected to take place during the budget period. So this is the additional, for the problem, the additional cash budget information. Assume the following information for Ryle: maintains a 16% open line of credit for $75,000, maintains a minimum cash balance of $30,000, borrows on the first day of the month and repays the loan on the last day of the month, pays a cash dividend of $49,000 in April, purchases 143,700 of equipment in May and 48,300 in June, both purchases paid in cash, and has an April 1st cash balance of $40,000. So the cash budget. We first have our beginning cash balance, which was 40,000. We add the cash collections and we get the total cash available. So that's $210,000 here. Then we decrease the cash disbursements, which includes of materials, direct labor, manufacturing overhead, selling, administrative, and equipment purchase and dividends, which totals to 228,000. So over here, you will either get an excess or deficiency, depending on if the total cash available is more than or less than the total disbursements. For April, there's a deficiency of $18,000 because the cash available couldn't meet the total disbursements. So because Royal maintains a cash balance of 30,000, they must borrow 48,000 on 48,000 in order to meet that cash balance, because 48,000 minus 18,000 is $30,000. So the ending cash balance for April is the beginning balance for May, which is $30,000, the ending cash balance. But they had to borrow the 48,000 in order to meet that criteria. So as you can see, the ending cash balance for April is the beginning cash balance for May, and you repeat that process for the rest of the months, and you add all the months to get the quarter. So question is, what is the excess or deficiency of cash available over disbursements for June? So in order to do that, we just calculate the cash whether it's excess or deficiency for June. So the cash budget is completed, and it's now a budgeted income statement with interest expense from the cash budget. Ryle can prepare the budgeted income statement. So next we'll be preparing the budgeted income statement. So for the budgeted income statement for 3 months ended June 30, first we get the sales, 100,000 units with $10 per unit equals to $1 million, and the cost of goods sold 100,000 units, and the cost of goods sold, which was 4.99, which equals to 499,000. Yep, that's the ending finished goods inventory. This will give us a gross margin, to which we subtract selling and administrative expenses to get the operating income. Then we subtract interest expense to get the net income. So we will prepare the budgeted balance sheet. So additional information, RAW reported the following account balances prior to preparing its budget financial statements. For land, 50,000, common stock 150,000, and equipment 175,000. So the main part is you for the assets, you add in cash, accounts receivable, the raw materials inventory, finished goods inventory, land 50,000, and equipment to get total assets. And for the liabilities, you need accounts payable 28,400, and for common stock, which was 150,000 as stated in the previous information. And for retained earnings, you have to get the beginning balance, which was 248,650, and add your net income for that month, decrease the dividends to get the ending balance of 438,730, which gives you a total of $617,130. So this is the end of chapter. Next, Zeno will be discussing the problems for chapter 8.
Can you enable screen sharing?
Just make him the host. You can do it with the same, like in more. Oh yeah, okay.
Okay, so I'll be explaining the review problem for chapter 8. So the question is, minor corporation manufactures a sales and seasonal product that has peak sales in the third quarter. The following information concerns operations for year 2, the coming year, and for the first 2 quarters of year 3. A, the company singles product sells for $8 per unit. Budgeted unit sales for the next 6 quarters are follows. are as follows. B, sales are collected in the following pattern: 75% in the quarter the sales are made, and the remaining 25% in the following quarter. On January 1st, year 2, the company balance sheets show 65,000 in accounts receivable, all of which will be collected in the first quarter of the year. Bad debts are negligible and can be ignored. B, the company desires an ending finished good inventory at the end of each quarter equal to 30% of the budgeted unit sales for the next quarter. On December 31st, year 1, the company had 12,000 units on hand. D, 5 pounds of raw materials are required to complete 1 unit of product. The company requires ending raw materials inventory at the end of each quarter equal to 10% of the following quarter's production needs. On December 31st, year 1, the company had 23,000 pounds of raw materials on hand. And E, the raw materials cost 0.8 per pound. Raw material purchases are paid for in the following pattern: 30% paid in the quarter the purchases are made, and the remaining 40% paid in the following quarter. On January 1st, year 2, the company balance sheets showed $81,500 in account payable for raw material purchases, all of which will be paid for in the first quarter of the year. So the question is, number 1, make a sales budget and expected cash collection. So to make the sales budget, you can use A, the single product sales for $8 per unit, and this is the budget unit sales. So we just multiply it, and this should be the result. For year 2, quarter 1, 40,000 multiplied by 8. Quarter 2, 60,000 multiplied by 8. Quarter 3, 100,000 multiplied by 8, and quarter 4, 50,000 multiplied by 8. You'll get this for the total. And in year 2, for the total, basically the sum of all the quarters would be 2 million. And for the expected cash collection, it is said that 75% in the quarter sales are made, and the remaining 25% in the following quarter. And 65,000 is the accounts receivable. So to make the expected cash collection, first 65,000 on the first year, in the first quarter, and then as we can see from the sales budget, on quarter 1, and 20,000. So 75% of that would be 240,000. We'll put it on the first quarter, and after in the second quarter, you'll put the 25%, which is 80,000. And same goes for all of the other quarters. And so you'll get the total 305,000, 440,000, 720,000, 500,000. And this is basically the sum of all the quarters. And for the second question, a production budget. So we'll be using the C right here. Okay. So we'll be using this one. Same, the budget unit sales, add the desired ending finished good inventory, and the total needs. After that, the less beginning finished good inventory and the production required. So first of all, to find the add desired ending finished good inventory, that is the 30% of the next quarter. So which is 18,000, and for 100,000, 30% will be 30,000. For 50,000, the 30% is 15,000, and on the 70,000, the 30% is 21,000. Also for the 80,000, the 30% is 24,000. So we'll add all this, and we'll get 58,000, 90,000, 115,000, 71,000, and 271,000. Also 94,000. So for the year 2 total, the added desired ending finished goods is the same for the fourth quarter. And for the less beginning finished good inventory, is basically the 30% of each of the quarters. So the first quarter is 40,000. So the ending finished good inventory is the 30% of the 40,000, which is 12,000. And for 60,000 is 18,000. 100,000 will be 30,000. 50,000 would be 15,000, and 70,000 will be 21,000. For the year 2 total, for the ending finished good, a beginning finished good would be the same for the first quarter. And in year 3, quarter 2, there's no added or less beginning finished good inventories because there's no the quarter 3 information for year 3. And for the third one, which is a direct material budget and a schedule of expected cash payments for purchase of materials, we'll be using D and E. So first of all, the required production in units of finished goods we can get from the production budget. The units of raw materials needed per unit of finished goods would be 5 because the question said so. 5 pounds of raw materials are required to complete 1 unit of product. So we multiply all that and we'll get the units of raw materials needed to meet production. So from here, we'll do the same. The added desired units of ending raw materials inventory would be the 10% of the next quarter, as stated in the question. So 36,000 from 360,000, 425,000 multiplied by 10% would be 42,500. And the 10% of 280,000 would be 28,000, and 365,000 multiplied by 10% is 36,500. So after all this, you add it and you'll get the total units of raw materials needed, which is 266,000, 402,500, 453,000, 316,500. And this is the total of year 2, which is 1,331,500. And for the last units of beginning raw materials inventory, we will take the 10% from the units of raw materials needed to meet production. So 230,000 will be 23,000, 360,000 will be 36,000, 425,000 will be 42,500, and the 280,000 will be 28,000. So after that, we can add all this, reduce all this, and we'll get the units of raw materials needed to purchase, which is 240,000, 366,500, 410,500, 288,500, and for the total would be 1,308,500. So the unit of cost of raw materials will be 0.8 because, as stated in the question, the raw material cost is 0.8 per pound. So after multiplying it, we'll get the cost of raw materials to be purchased, which is 194,400 for the first quarter, 293,200 for the second quarter, 328,400 for the third quarter, and 230,800 for the fourth quarter. And the total is 1,046,800. So the next one would be the expected cash payments for purchase of materials. So we'll be using the data from the raw materials needed to be purchased down here. And then as the question states, 60% paid in the quarter the purchases are made, and the remaining 40% paid in the following quarter. So 194,400 multiplied by 60% will be 116,640, and the rest of it will be on the following year quarter, which is 77,760. Also for the cash payments, we'll be adding the accounts payable, which is different from the first one, which is expected cash collection. We'll be using the receivables. So the next quarter, 293,200 multiplied by 60%, we will get 175,920, and the rest would be 117,280 on the following quarter. Same for the quarter 3 and quarter 4. Oh, that's a mistype. Should be quarter 3 and quarter 4 over there. And after that, we'll get the total cash disbursement, which is 198,140, 253,680, 314,320, and 269,840. And for the total is 1,035,980. So that is all for the review problems. Thank you for listening.